What's up traders, Chosen Trades back here with another video for y'all. Today's video I'll be talking about liquidity and how it relates to ICT style trading. Let's get into it. Alright, so what is liquidity? Liquidity is ultimately what fuels the market and drives price to where it needs to go. Liquidity are areas where retail stops are located, for example, relative equal highs and relative equal lows. Liquidity can also be at areas of swing high and swing lows. To break it down even further, buy side is liquidity resting above relative equal highs, and sell side is liquidity resting below relative equal lows. So let me just give you a visual example of that. So right here would be an example of buy side liquidity, which is ultimately the swing high, and an example of sell side liquidity could be right here, relative equal lows. Move this over to the right. Another example of sell side liquidity be right here. On a deeper level, alright, so yeah, these are examples of, like I said, at the swing high with relative equal highs. This is where liquidity is resting above, so the dollar sign right here just to show an example of liquidity resting above. So that would be an example of liquidity resting above relative equal highs for the buy side. And then an example of liquidity for sell side would be here resting below. Provide another example right here. You see liquidity is resting below. You can see that price took out this liquidity and then immediately went up, making a reversal and chasing after buy side liquidity. So on a deeper level, we also have liquidity categorized as external and internal liquidity. To start off, external would be areas that I mentioned where retail traders have their stops, so at these relative equal highs and relative equal lows. So typically, retail traders would have their stops below here. If they were going long, they would have their stops below here. If they were going high, they would have their stops above here or even above here. Because this is also relative equal highs. I can even mark that up as well for you guys. Right here would be an example of relative equal highs where buy side, where liquidity is resting above here, and we have our retail traders just putting their stops just above it. And we can see in the charts that eventually price takes out this high, takes out the high, reverses, does a liquidity sweep, reverses, and then moves the market lower before continuing up. So usually when you see areas where highs are relatively at the same area or zone, those are typically where you don't want your stops to be. You want it to be simply after smart money has made their move and you see a clear indication that liquidity has been swept or there has been a liquidity run. And then here would be an example of external liquidity, or even right here, this would be a much better example where there's relative equal lows. We see that there's liquidity resting above or resting below here. See that there's liquidity resting below here, so we see price take out that relative equal lows, does a reversal, does a liquidity sweep, and then aggressively moves price in the opposite direction, pushing price up towards the upside. An example of internal liquidity, which is the other aspect of liquidity outside of external, is internal liquidity. And internal liquidity are areas where the algorithm needs to have a balanced price range. With this in mind, price will typically trade into an imbalance or fair value gap to rebalance price and drive it to its intended directions. It can also be when price does a liquidity sweep, performing a stop rate to take out weak traders and immediately reverse price back in the direction opposite of the sweep. So let me show you guys an example of internal liquidity. So right here we can see a clear imbalance that price has left in the market for price to eventually trade into, rebalance, and then continue to reprice. So we see that price aggressively moves lower, and we haven't found You see that price does a market structure shift along with a displacement. So I typically would either do this from the dealing range, so from the swing high to the swing low. And then with this dealing range, we know that we have a bearish bias. So now that we know we have a bearish bias, we typically would fib from swing high to swing low after we have this market structure shift, which is typically at that intermediate or short-term high, I should say. Yeah, this short-term high. See that price does a market structure shift followed by displacement. See that price does not trade back into this premium level of 62 or 70 fib level. We try it here, we still don't see it. We try it here. We see that price hasn't got just there yet. We fib from here. We also see another internal liquidity right here where price can trade into. So we see price run up into here, moves a little bit lower, then runs up, then moves a little lower, but then aggressively does a liquidity run to come back into this fair value gap or imbalance, if you will. And this wouldn't necessarily be a valid imbalance or fair value gap because the market has reversed. We're looking at bullish momentum here, and we know that if we even go up to the 1 hour, as mentioned before, price aggressively moves lower, takes out these relative equal lows as well as these relative sell side liquidity as well. So then we see here price purposely pushes down, forming that stop raid, doing a liquidity sweep to the downside, and then we see that the momentum of price is bullish. So that's why if we mark up this internal range of liquidity, we know from the dealing range of this swing high to this swing low, it wouldn't be a valid entry to go short. It wouldn't be a valid entry to go short because price is currently on a bullish momentum. So price really is just using this liquidity to just push the market down to grab liquidity from here to continue the move up. Just to remove the fib tool. Yeah, it pushes, it just uses the liquidity from here to just take the market lower to really get this area of liquidity to continue pushing the market up. So this would be simply a liquidity run to the upside. And then we see here price runs up into this imbalance that I had mentioned and aggressively moves price lower. And typically you can classify internal liquidity as internal highs and low where it is within a certain trading range. So from this high, you can mark it up here. From this high to this low, we see this is a trading range where price is just going to trade into this internal high just to simply grab liquidity and move the market lower. Another example of internal liquidity is even right here where we simply see this fair value gap. This would be considered a buy side imbalance, sell side efficiency. It's a buy side imbalance because we're offering buy side, where the market is bullish and we're offering simply only buy side. It's sell side inefficient because price still has to trade back into this area to rebalance price to continue taking it higher. So it has inefficient levels of sellers coming into the market, if that makes sense. So now that this is a buy side imbalance, sell side inefficiency, we are finally efficient because price has finally got back into this level, has rebalanced, has repriced right back into this zone, and now it's going to continue aggressively push the market higher. And we see that here with price taking out, for example, this internal range of buy side. Internal range of buy side at relative equal highs. This is where liquidity is available. You could have took a position here, went long. This would have been a London trade. Would have had your entry somewhere around here or even in the middle somewhere. Targeted this equal high. had your stops below here, or even if you jump down to the 5-minute. If we jump down to the 5-minute, you see that price respected the zone here pretty well. So once price had traded here, you could have had your stops even right here, or even right here. If you're comfortable, since price had already traded into this imbalance, you could have had your stops right below here. Had a nice 1 to 3 trade and you would have been done for the session. TP would have been hit in New York. TP would have finally hit in the 2nd hour of New York. But this definitely is a nice setup to take, where we see the internal range of liquidity, finding our setup. You know, we see that we have a bullish narrative. And we're just looking to take advantage of price action moving in our favor. Alright, thank you guys for watching this video. This was a quick video on liquidity, just, you know, making you guys, just pointing a few things out when it comes to liquidity in the markets. If you have any questions, drop them in the comments below. As always, like, comment, share, and if you found this video insightful, share to other people as well. The channel is growing steadily and every support means everything. As mentioned previously, if there's anything you would like to know more about liquidity, drop them below in the comments and I will be more than willing to answer your questions. Signing out, Chosen.